Welcome to Prime Perspectives, where Keith Galicia guides you to the financial finish line. As a certified financial planner practitioner, he covers all topics in financial planning. Join him each episode to gain insights and strategies, helping you pursue your financial goals together.
Welcome, guys, to the next episode of the Prime Perspective podcast, where our goal is to help you get to the financial finish line, whether it's anything from estate planning, retirement planning, education planning, or even risk management. Today, our conversation is going to be around evaluating options for your portfolio. And so for today, we have Jeff Stern. Jeff, thanks for showing up today.
Yeah, thanks, Keith. I appreciate you having me on.
Absolutely. And today we're going to discuss maybe some options for your portfolio that you haven't really thought about. They're called alternative investments. So, Jeff, let's get into it. Jeff, do me a favor. Can you tell me a little bit about your background and how you got into financial services?
Yeah, sure, Keith. So my background, my name's Jeff Stern, as you mentioned. I work at Simplify Asset Management. We're a company that focuses on ETF strategies. We were started in 2020 with the goal of bringing institutional caliber exposures to advisors like yourself in easy to access ETF form. What we really sought out to do was democratize alternative investments by putting them in easy to access ETF wrappers. So in my role as an investment strategist, I work with a lot of financial advisors, helping them build more robust portfolios for their clients. As far as background, my whole career has been in asset management, but I've had a variety of different roles. I've worked on the institutional side of asset management at both BlackRock and PIMCO, mostly with insurance companies and also some regional banks. I was an advisor myself for about 6 years at JP Morgan. I did a short stint in crypto, but on the asset management side at a startup hedge fund. And now I'm at Simplify, as I mentioned. So the one common theme has been investment management, but I've worked both on the private wealth side and on the institutional side.
That's awesome. Hey, Jeff, could you do me a favor? And for those that may not be familiar with ETFs versus mutual funds or even individual equity positions, could you just give us a quick definition of what an ETF is, maybe versus what most people think of as mutual funds and what that versus might be?
Yeah, we could definitely go into that much more in depth, but just to keep it fairly high level, mutual funds and ETFs are both types of 1940 Act strategies. And these vehicles allow investors to invest in a commingled set of securities. The main difference between mutual funds and ETFs are mutual funds trade at one price per day at the end of the day. So if you say you want to buy mutual fund shares at 10 a.m. or 12 p.m., you're going to get the same end of day pricing. Whereas exchange traded funds, ETFs, they trade throughout the day, just like stocks. So they trade on an exchange, and if I want to buy at 11 a.m., I'm going to get the price that the market is trading at that point in time. Same with if I decide to buy later in the day. So that has some advantages in terms of liquidity. ETFs also are more transparent. You can see their holdings on a daily basis, whereas mutual funds only have to post their holdings on a quarterly basis. And then oftentimes, especially for equity strategies, ETFs can be more tax efficient. So in many ways, I would say ETFs are kind of an evolution of mutual funds. So similar to how cell phones were kind of an evolution of landlines, I think you can think of mutual funds and ETFs very, very much that way.
I think that's about the best way you could explain it. Most people are familiar with mutual funds, and ETFs are certainly a lot more common now in the industry. But I think it is important that if we are talking to maybe one of those startup investors, that they understand the difference there. So thanks for that. Hey, do me a favor. What inspired you? You said you've been in financial service your whole life. Was there some light bulb that went off where you said, hey, this is my career path. I'm going to stay in financial services. Well, I'm going to start in financial services and stay there so far.
Yeah, I mean, that's a great question. I think for me, I always knew I wanted to work in the investment world, and I don't know exactly why. I grew up in New Jersey. I was fairly close to New York City. I was always fascinated with Wall Street and investing, even from a fairly young age. but I didn't know what exactly I wanted to do in the investment management world. So as I had some internships in college, I started to figure out that I was best suited for a more client facing role as opposed to something more operational or maybe portfolio management or research. I like working with people. So that kind of helped me gravitate throughout my career towards more of the wealth management side of the business, which gives me more opportunity to work with individuals when I was an advisor, or now working directly with financial advisors and helping them serve their clients in the best way possible.
Yeah, sure. I think one of the things that most people need to really understand is that as advisors, we're always looking to bounce ideas off of other people that have their ear to the street or have access to some of the top research out there. And when we can bring those ideas together for our clients, we certainly look to create better potential for outcomes there. So yeah, that's kind of where our relationship ends up. And is there a specific area of investment that you specialize in? Is it only alternatives, or can you expand a little bit more about what areas you focus on?
Yeah, so Simplify has grown to about 28 strategies. We've got things across equities, fixed income, and then liquid alternatives. I would say people probably know us best for our income strategies. Many of them use options. They may sell options to generate enhanced income with different underlying betas. And then we've got our liquid alternative suite of strategies. So these are uncorrelated, basically hedge fund strategies that are in an ETF wrapper so that they're more accessible to any type of investor, as opposed to some of the alternative investments that are in private fund structures are only available to accredited investors or qualified purchasers. So you have to have a certain net worth in order to buy those strategies, whereas ETFs make them accessible to anyone.
Great. Well, I'm going to ask you a couple questions, and this is going to lead into potentially some of the reasons why somebody might look to implement alternative strategies into their overall portfolio here. How would you describe the current state of financial markets?
Yeah, I mean, that's a great question, and the one that we're always trying to figure out. And it seems like a never ending process. And one of the things that I think makes this business so much fun to work in, coming out of COVID, just taking a step back, we really saw unprecedented monetary and fiscal stimulus from the government, which we had interest rates near zero, the lowest we had ever seen on the 10-year, sub 50 basis points at one point in time. And I guess in some ways, not surprisingly, in hindsight, it created a lot of inflation. And the Fed was rather slow to react to that. So they had to jack up interest rates over the last couple of years at the fastest pace we've ever seen. And I think that a lot of investors question, is that going to eventually lead to a recession? And earlier this year, things were looking pretty promising that we might actually get a soft landing, that the economy seemed fairly resilient. We were weathering these dramatic interest rate increases fairly well. Unemployment was still low, but I think we're now starting to see some cracks in the economy, and the data is starting to be a bit more mixed. So it looks pretty certain that the Fed is now going to start cutting interest rates to help stimulate the economy a bit more now that unemployment has picked up. We've seen some of the jobs numbers have been more weak as of late. So I think all eyes are really on the Fed in September and what they're going to do. The expectation is that they're going to cut probably 25 basis points, but there's even a fair chance they may look to cut by 50 basis points. And then the other question will be, how much do they cut the remainder of this year? And do they cut fast enough to avoid some sort of economic downturn? Or do we end up seeing that recession that has maybe taken a bit longer to unfold, but with higher interest rates, it does put brakes on the economy?
So if that's a conversation that maybe some research analysts, obviously no one has a crystal ball, but everything you're saying there is factual. What major trends we've seen? NASDAQ, S&P 500, Dow, all at all-time highs, have really sharp rebounds coming from the 2022 lows. What trends are you observing in the investment world right now that some of the portfolio managers are positioning for?
I think in my mind, fixed income bonds are the most interesting they've ever been in my career. You can get some very attractive yields today without taking a lot of risk. So as we see the economy slowing, and like you said, equity markets are at or near all-time highs, you can get some really nice returns in fixed income without taking a lot of risk. And if the Fed does start deciding to cut interest rates, by taking duration risk, exposure to interest rates, you can actually get some price appreciation in your fixed income as well. So while you may have gotten hit the last couple years if you own bonds as interest rates rose, now you actually have an opportunity to potentially have some tailwinds with the Fed looking to cut rates. So I've been having a lot of conversations with advisors who had been holding a lot of money market funds and treasury bills for their clients, not wanting to get hurt by higher rates as the Fed was raising rates. But now I think is the time to start adding duration, adding exposure to interest rate risk, and moving further out the yield curve. So we've been having a lot of conversations with advisors on that topic.
I've had a lot of conversations with clients that have great yields on a money market right now, higher than what we've seen in a very long time. Short-term CDs, 5, 6, 8 months, really good yields on those. But the thing is that if you go out and buy a CD today, Fed decides to drop rates 6, 8 months from now, rates are less. Well, with the CD, you just only have to take whatever that lower interest rate if that bank decides to drop those rates. When you own bonds or fixed income strategies with longer duration, you can continue to with that yield for that certain period of time. But I always tell people, well, if you have a 5% bond and now the new market's 4.75 or 4.5, well, that 5% bond should be worth more because now the new marketplace is less than that. So you get what we see total return, which gives them the opportunity to keep the yield and then also have the potential for increase in value for those bonds.
Exactly. You want to lock in those higher rates while they're still available. And then if the Fed does end up cutting, you're going to get some price appreciation in those bonds as well that have exposure to interest rates.
Yeah, for sure, for sure. Are there any other sectors or asset classes that you're currently bullish or bearish on that's kind of top of mind for you outside of fixed
Yes,
income?
so kind of diving into even fixed income a little bit, one of our favorite sectors that we've been pounding the table on is agency mortgage-backed securities. These are bonds that are issued by the quasi-government agencies like Fannie Mae, Freddie Mac, Ginnie Mae, and they trade at a spread above treasuries. So you can earn a little bit of extra yield by investing in agency mortgages versus a similar duration treasury. And the reason you get that extra compensation is because there's some prepayment risk. So people can prepay their mortgages that these MBS hold, and then you can get your money back maybe sooner than you would have liked. But right now, you're getting really well compensated for taking that prepayment risk. The spreads above treasuries are near historic wides. And so you can get some really nice yield without taking credit risk. That's an area that we don't like right now is credit risk, both investment grade and high yield, because spreads are very tight and we're starting to see some signs that the economy may be slowing down. So we think it's a great time to invest in agency mortgages and probably a good time to maybe avoid high yield or investment grade credit, or at least be more selective in those areas on the types of bonds that you own.
Nice, nice. Well, that leads me into the crux of our conversation today, which are alternative investments. So we've kind of given a 30,000-foot overview of markets and all the above, but let's talk about how alternative investments are mindful of those types of conversations and how somebody could complement their portfolio with alternative investments. So before we start, give me the definition of what is an alternative investment and how they differ from your traditional stocks versus bonds type of approach.
Yeah, it's a great question because I think if you ask this question to 10 different people, you might get 10 different answers. I think of alternatives as everything that is not a stock or a bond. So that can include real estate, commodities, private equity. It could include private credit. It could include crypto. hedge funds. So there's a whole variety of assets that you could put in the alternatives category. And arguably, alternatives is a larger asset class than even stocks and bonds, if you look at it that way. So I think there's a lot of opportunity in the alternative space. You don't want to necessarily shop in one aisle in the supermarket. So you don't necessarily want to limit yourself to just publicly traded equities and bonds. There's a lot of other opportunities to invest out there as well.
Well, like you said, there are alternative investments is a huge menu of and probably a lot bigger conversation that we could stuff into this podcast. But so let's still, I guess, let's isolate it most to the types of alternative investments that you deal with. Can you explain to me the overall philosophy of alternative investments in a portfolio? Is it to be low correlated to stocks, bonds, and then maybe explain to the audience if that is the answer, what low correlation means as well?
Yeah, great question. I think there's obviously different reasons to include alternatives in your portfolio depending on what your goals are and the types of strategies that you want to use. So while someone might use something like private equity or venture capital to try to earn excess returns over what they might get in public equities, other alternative strategies like hedge funds and the types of things that we offer, liquid alternatives, those are more intended to be portfolio diversifiers. So the goal there is to help dampen your overall portfolio's volatility, increase diversification, and that can help your returns compound better over time.
Yeah, especially if we're looking, could be potentially in an election year. What about the uncertainty? And like we know, there's the crystal ball is not always clear, and unless you have had your head buried in the sand, there's certainly been a lot of geopolitical events, and even an election this year. How do geopolitical events and economic policies influence alternative investments?
Yeah, I mean, certainly they can have big impacts on any type of investment, not just alternatives. I think when you think about alternatives, you could bucket it as more of the illiquid alternative strategies. Those are going to be those private funds that may have 10-year lockups. And I think certainly when you're going into one of those vehicles, you need to really think ahead as to what the world may look like over that period of time, because policy and geopolitics is going to have a major impact. On the liquid alternative side, what we often talk about, we're really trying to build all weather portfolios. So some of the liquid alternative strategies are designed really to give you diversification and weather those storms if you have those geopolitical shocks. A strategy like a managed futures, for example, they actually tend to do well when there's big regime shifts in markets. So if there's a shock to oil prices, for example, something like managed futures may perform well even when your stocks and bonds may not be performing well in those types of scenarios. So I think that's a prime example of why you may want to have these liquid alternative strategies, is to build a much more robust kind of all-weather portfolio that can stomach these types of shocks.
Can you explain to the audience what managed futures are?
Yeah, so managed futures, it might sound almost a little too obvious, but assets that have a positive price trend are actually more likely to continue increasing in price. And then the flip side is actually true as well. If an asset is decreasing in price, it may actually have a higher likelihood of continuing to decrease in price. So there's a factor of momentum that you can apply to different asset classes. Nothing tends to have historically trended more than commodities. So a lot of managed futures strategies will go both long commodities that have positive price trends and short commodities that have negative price trends. And what this can do is actually create a positive long-term return, but have negative correlations to stocks and bonds. So it can really act as a diversifier in your portfolio. So it's like getting paid to own your hedge. They have positive absolute returns over a longer time horizon, but actually negative correlations to stocks and bonds.
Right, which is the goal of alternative investments, to find some kind of lower correlation than that teeter-totter approach of stocks to bonds. Bonds go up, stocks go down, stocks go up, bonds go down. Sure. Let's wrap this up with just a couple more questions. And I really love everything that we've talked about today. What do you see as the future of alternative investments? And are there any sectors now that aren't necessarily mainstream, but seem to be a larger conversation that you're hearing about and might become more mainstream in the near future?
Yeah, I mean, I think alternative investments have really just exploded over the last 5 to 10 years. The menu of options has gotten wider and wider. And I think now having more accessibility, whether it's through the ETF structure, you now have these interval funds where they're semi liquid and investors can get into strategies like private equity at a much lower dollar amount, is making it a lot easier for your run of the mill investor to get some type of exposure to alternative investments. And I think that trend of democratizing alternatives is only going to increase as time goes on. I mentioned earlier I worked in crypto blockchain. I think that's going to play a big role in making it easier for people to access alternative investments over the coming years. You'll start to see more funds, maybe even tokenized. It's starting to happen now, but I think that trend may only continue. So I think the menu of options to investors is only going to get broader and broader, and people will not just be investing in stocks and bonds in portfolios. In 10 years, I would expect more advisors will have a large allocation to alternatives of a variety of different strategies within their portfolios.
So let's finish up this last question here with a little advice for new investors. For a long time, there's been a large conversation, well, just buy an S&P index. Warren Buffett says, hey, just throw your money, dollar cost average in S&P index, and at the end of your retirement, you should have pretty decent potential for return. What advice would you give someone who is new to alternative investments and considering allocating alternatives into their portfolio?
Yeah, so I think the big reason that you would want to have an allocation to alternatives is diversification and making your portfolios a lot more robust. So reducing volatility. And if you can reduce your volatility, your returns will compound better over longer time periods. And that's really, I think, the benefit of using some of these alternative strategies in portfolios. And if you can make a more resilient portfolio, you're also going to be less inclined to have some of your behavioral biases that we're all kind of ingrained with. So I think investors naturally tend to sell at the worst possible times, oftentimes when asset prices decline. And then they tend to chase returns on the upside too. They tend to be buying as markets are getting exuberant. So having more robust portfolios with lower volatility, I think can let investors really just like focus on what they want to on their day-to-day lives, have a portfolio with a smart allocation that they know is going to weather the storms that markets inevitably are going to bring over time.
Well, Jeff, I think you really killed it today with all the information, basically all things under the hood of alternative investments, at least within what's important for this conversation today. Thanks for showing up and spending the time. And audience here, if you really enjoyed this conversation and you want a little bit more, learn a little bit more about alternative investments and how they can help complement your portfolio, please reach out to me, Keith Galicia at primeportfolioplanning.com. You can also find me on all my social media links, which is Facebook and LinkedIn as well. Jeff, once again, thank you for your time. Folks, stay tuned for the next Prime Perspectives podcast. Take care.
Keith Galicia is a registered representative with and securities and advisory services offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Jeff Stern is not endorsed by or affiliated with LPL Financial and Prime Portfolio Planning.